The oil industry is in turmoil, and it's not just about fluctuating prices, it's about survival. What happens when the very foundation of big oil's confidence starts to crack? Earlier this year, major oil companies boasted resilience in a $60 per barrel market, with ambitious spending plans and no whispers of layoffs. Fast forward 6 months, and the narrative has shifted dramatically. Despite oil prices lingering between $60 and $70. The sector is retrenching, raising questions about its long-term strategy. But here's where it gets controversial. Are these cuts a necessary adjustment or a sign of deeper trouble? U.S. shale jobs are disappearing at their fastest rate since 2022, when oil prices plummeted from over $100 to below $80 in just 6 months. While the 1.7% job loss might seem modest, it's part of a larger trend fueled by a 125% drop in oil prices since the start of the year. Bloomberg highlights that demand for oil is tepid, and analysts predict things will worsen. ConocoPhillips recently dropped a bombshell, announcing plans to slash up to a quarter of its global workforce. The company framed this as a reorganization for efficiency, but many see it as a desperate move. And this is the part most people miss. When oil giants cut jobs, it's often the first sign of distress, not just a strategic pivot. Chevron's February announcement to cut 20% of its workforce, though tied to its Hescorp acquisition, also coincided with the price downturn. Coincidence or a pattern? Chevron CEO Mike Wirth summed up the sentiment, calling the final quarter of 2024 a negative direction. Beyond jobs, spending is also on the chopping block. Reuters reports that 22 U.S. oil companies, including Conoco and Occidental, have collectively slashed $2 billion in spending. Kirk Edwards, CEO of Latigo Petroleum, aptly described the shift from drill baby drill to wait baby wait. His warning? These job cuts are a flashing red light for the entire U.S. oil and gas industry. The alarm is sounding primarily due to bleak demand forecasts and fears of an oil glut. At the Asia-Pacific Petroleum Conference, analysts predicted Brent crude could dip below $60 this year and stay there into 2026. Wood Mackenzie went further, forecasting prices around $50 per barrel for years, unless geopolitical events intervene. Yet, these projections overlook a critical factor. Oil producers often curb production in response to price drops, tightening supply and eventually pushing prices back up. History has shown this cycle repeatedly. Here's the kicker. While the industry is cyclical, recent price swings have become increasingly detached from physical market realities. Still, companies are reverting to their playbook for downturns. Cut jobs, reduce spending, and wait it out. Wood Mackenzie predicts a 4.3% decline in global oil and gas exploration spending this year, the first since 2020, underscoring the industry's precarious position. If Brent falls below $60, majors may struggle to maintain capital spending and, crucially, dividend programs, which could rattle shareholders. Ironically, analysts overwhelmingly predict no price rebound. Yet 2024 has shown how quickly assumptions can flip. U.S. shale growth, once a given, has already reversed, with production dipping from 13.6 million barrels daily in December to 13.4 million in August. While busts may linger, booms inevitably follow. The question is, are we witnessing a temporary slump or the beginning of a structural shift? What do you think? Is the oil industry's retrenchment a prudent response to market conditions or a sign of deeper vulnerabilities? Share your thoughts in the comments. Let's spark a debate.